Hey guys, welcome back to the channel. I hope everyone is doing well. So today I thought it might be interesting to kind of go back into the past and see if there's any lessons to be learned from a cover called OG ETF. This one is from Invesco. This is PBP. So let's get into it. So first, I just want to give a shout out to this nice viewer. For supporting the channel. This was a very nice super thanks. So thank you very much for that. And I thought this would be like an interesting topic, just because I was kind of wondering if all cover call ETFs or any similar option premium based ETF might wind up like PBP. And the reason why I chose this particular ETF is because it's not a slouch. This is from Invesco, so this is the creator of the regular Triple Q, which itself is like a ETF OG. And this particular ETF, PBP, survived the Great Financial Crisis, and it also survived like the aftershocks of 2020. So just to go over a little bit of the history, this started December 20th, 2007. It's stock based, and they're using SPX cover call strategy, and they also do a monthly payout. So this is very similar to some of the funds that we all know and love. It could be like JEPI, JEPY, etc. And what I like about this particular fund, it actually shows you like the intraday stats. I think this is a very good idea, and I wish every ETF family did this, because this is kind of like where, like for example, in some of my dashboards, you can see like the difference between a NAV and a close, and obviously you want to buy at a discount to NAV, and unfortunately, not all fund families show this in real time. And this is one of the few times that you can actually see it on an intraday basis, so you don't have to do a lot of crazy calculations. It shows you this directly on the website. So again, just to as a maybe as a hint to like other ETF families, yeah, maybe if you can do this as well, I think that would be a really great idea for like the space in general. But of course, like we'll just have to see. In the meantime, I did crunch some of the numbers, just to go over like the NAV, because I do appreciate like any ETF fund family that gives like the public investors like the information via a spreadsheet, just because it makes it a lot easier just to do a lot of the calculations. So for example, the maximum NAV for this ETF was $25.60, and on the flip side, like the minimum was it reached as low as $14.79, and then the average net asset value was $21.03, which is kind of close to like what it is trading at now. So that might be just a coincidence. So you can kind of tell just like the difference between the max and the minimum net asset value. It's possible that this could draw down like 42%. Of course, I'm not saying this will happen. I'm just saying that just based on the past, it could happen. So let's take a look at some other stuff. Unfortunately, this is where things get kind of I wouldn't say hairy, but it's not like the most exciting. Since inception, like the NAV, like the returns, 4.22%. This is barely keeping pace with like any like a treasury fund. So this is probably one of the drawbacks, and it's one of the things to kind of keep in mind. Unfortunately, not every year is going to be like a outstanding performance, and then like, but this is like over the entire life of the ETF, so you have to take that into account. And this is a survivor, so you have to kind of be a little bit gentle with this guy. And also, I also want to kind of point out that, well, they only had like the 10-year comparison, so it would have been interesting to kind of to see like the full over the full life of the ETF. But this is what we have to work with, so we just have to deal with it. So over 10 years, the past 10 years, if you had just bought like a SPX based ETF such as a SPY, you could have gotten a little bit over a triple. Whereas if you just bought regular PBP, you would have done, like 1.7 times better, so almost like half. But of course, like you have to realize, anytime you you engage in a covered call ETF, you have to kind of expect kind of like a laggy performance. So this is, you have to make a trade-off somewhere. And just to kind of crunch some more numbers, like I went back to the distributions. At one point, like if you could have gotten like as much as like $1.84 on a month, and then again on the flip side, you could have only gotten like a penny for a month, and then like the average is about 22 cents per month, and then the total distribution since inception. So like for every one share that you bought, you could have gotten back like $16.61 if you held, if you bought like when it came out and then it held all the way through. So just like kind of like some lessons maybe for the future. Even name brand ETFs can struggle. Even just because like it's a big company, like for example like BlackRock or Fidelity, and I guess maybe in the future maybe like Neos and Yieldmax. I guess at some point, like I'm hoping they'll also do well enough so that they can survive. There's going to be times when ETFs struggle, and even if a high yield ETF survives, like the profits may not be like so great. So you have to keep these things in mind, and you always have to keep an eye on your portfolio. So I'm hoping like in the future, like maybe some of the newer guys can kind of learn like some lessons from the past. Don't get too cocky. Maybe look out for your investors. Like for example, like even for PBP, I noticed like on their website they recently like slashed the expense ratio. So in tough times, maybe other fund families can kind of consider doing this as well. But let's hope for the best. So if you like this type of content, please consider giving us a like. If you could subscribe as well, that would be great. Of course, like super thanks are greatly appreciated. So I hope people make some good money out there. Thank you for watching, and I'll see you in the next video. Bye now.